Hey guys, hope you and your families are well. Many of you have probably read this book, Trade Like a Stock Market Wizard by Minervini, and you probably got notes like I have all over the pages. So in this video, I'm going to take you through 4 annotated charts from the book. So these are 4 volatility contraction patterns, and on each chart, I'm going to try and teach you a different thing as well. I got a special bonus one for you at the end, which is more of a low pivot. So we'll be looking at low pivots that you'll read about in his books as well. I'm also going to show you a VCP from 1904 just to illustrate nothing has changed. You will see these chart patterns. If you were around in 1904, you would have seen the chart patterns now, and if you're here in 2023, you'll see them now, and you will see them 50 years, 100 years into the future. It's timeless. It is the law of supply and demand. Market Smith are the sponsor of this video. There is a discounted trial available in the comments below. So let's jump on into it, and before we start off with EDU, which is a really nice example, let me show you that 1904 example. So here we go. This is the Dow Jones Industrial Average. I'm sure you've all heard of that, and this is on the weekly chart. Now I'm going to show you 3. I'm going to show you a VCP from 1904, a VCP from 1905, and a VCP from 1927. So let's start off with 1904 and 1905. The key points, and then I would recommend that when you've watched this whole video, go back and look at the first part here, because I've kept kind of the notes off here, but just look at the contractions in price. So you are looking for contractions that are forming higher lows, and the depth of the contractions are preferably declining each time. So i.e., if you look at the depth of the contractions here, the first one is obviously very, very deep, 36%. But as you start then working from left to right here, do you see how the next contraction is then 8%? The next contraction is then 5%. The next contraction really starts tightening up, goes down to a couple of percent. This, in essence, is what you're looking for from a VCP. And don't worry, we're going to go well and truly into the weeds of supply and demand during this video. So these chart patterns happened in 1904, 1905, 1927. They're happening in 2020, 2023. They will be happening in 2080, whatever, right? It's just supply and demand. This is actually probably as perfect VCP you are ever going to see on a major index. So this just illustrates the point. Okay, first decline from peak to trough is 17%. Next decline, peak to trough, 12%. Next decline over here, peak to trough is about 5%, and then finally over here goes down to around about 3%. So this here in essence is the VCP, the volatility contraction pattern. But let's start taking it a step or two further and start looking at some examples from the Trade Like a Stock Market Wizard book. So the first one up here, this is EDU, and we're back in 2007. So you can see, as we were just looking at there on the Dow Jones weekly chart, you can see the 3 contractions in price here. So we'll start higher up, we'll then start working down into the weeds a little bit, where there's a couple of kind of nuances, some subtleties to be paying attention to as well. So we have 3 contractions, 3 main contractions in this base. Okay, we have the first contraction, which is about 23%. So I measure it from the peak to the trough there. So from the highest price level, that could be what I call a supply shoot, or to the low of a demand tail as well in terms of the low of the contraction. So you have 23%, price rallies, pulls back down. Second contraction is 9%. So it doesn't have to happen perfectly every time, but as you start getting these contractions, you want to see higher lows form, and preferably the depth of the contraction is around about halving each time. Now, it doesn't have to half each time, but you would like to see the depth of the contractions building the higher lows with the volume drying up as well. You would like to see that diminishing as you move from left to right. Why? Because it's an indication that there is absorption of supply going on. If the volume's drying up as well, there's less selling pressure coming to the market, so on and so forth. And I'll take you through a couple of analogies as well. And then as you come over here for the third and final contraction, this is where it goes to just -3%. So ideally, you'd like the final contraction to be in single figures. Why? If you read the books, Minervini talks about placing his stop loss underneath the low of the final contraction. He wants that to be in single figures, so he is maintaining a healthy risk versus reward relationship. But obviously, the tighter the final contraction, the tighter the price action means, the tighter stop loss that you can go in with. So therefore, you are risking less. So obviously, better if everything is equal, it would be better to go in to trading a VCP. If you imagine a similar VCP here, but the depth of the final contraction on a kind of parallel universe one is 6%, whereas this one is 3%. And everything else is equal, it'd be better to take the one with 3%. Why? Because you're taking half the risk on the trade. If you read the book, the risk versus reward and risk management is very, very, very important. So then a couple of subtleties as we go into the base. Now, You can commonly see as well, I've got the 10 EMA, which is the black line, 21 EMA, which is the blue line, purple line is the 50 SMA, then the grey line is the 100, and it's not shown down here because it's down here somewhere and I've enlarged the chart, is the 200 SMA. But commonly you can see that these contractions, certainly as you start getting over to the second half of the base and into the kind of final parts of the base, you can start to see price respecting those key moving averages, especially kind of the 21 EMA and the 50 SMA as well. So price actually holding the 50 SMA here on low volume, and this is a little gap down reversal bar, is good to see. Then you see when price rallies here and the third contraction is about 3%, it's really tight. Now, a lot of the best ones, and you're going to see this from the examples we work through, price will start tightening on the 10 EMA and the 21 EMA. So see how you get really tight price action. The final bar there is what I call a trigger bar. That is pretty much an inside bar sitting on the 10 EMA and or the 21 EMA. And then do you see how the volume is around about half the 30-day average? See how the volume is about half the 30-day average? That's really good. It's an indication there's very little supply that is coming to the market. If you think about, I'm going to give you an analogy here. If you have a towel, right, and you dip it in a tub of bath water, okay, you take it out, the towel is soaking wet. Think of each contraction as wringing the towel. So when you are wringing the towel, less and less water is coming out each time. Think of that as less and less supply is coming out each time. So as these contractions happen, okay, that is successive rings of the towel. So there's less water coming out, there's less supply coming out. So you're looking for depth of contractions to be diminishing. You're looking for structural high lows. You're looking for volume to be drying up as well, all as an indication that there is less supply coming to market, absorption is happening, weak hands are being replaced by strong hands, so on and so forth. A couple of other subtleties on this chart as well. Do you see how in the second half of the base, pretty much from here onwards, do you see how there is not a single volume bar above the 30-day average? That is really good to see, especially if you get kind of that VCP characteristics we were just talking about as well. One other subtlety as well is you see the stock before it even starts building this VCP base here, it's hitting 52-week highs on the RS line. I've got a free RS line on TradingView. Search my name in the indicators, you'll find it. But I like to look for those stronger stocks in the market, those leading stocks. Now this one here, this is maybe my favorite setup in the book. It also kind of illustrates the fractal nature of the market as well, that you can get setups formed within setups, bases formed within setups. So in this blue zone here, you actually have a mini VCP within a larger VCP, and there's three contractions in it. You have contraction 1, you have contraction 2, and then you have contraction 3. And it's the same point that we were just talking about. Structural high lows, depth of the declines are diminishing each time, and then these really tight trigger bars come in. But here you can see in terms of the main VCP, first contraction 23%, second contraction really tight. There's actually a low pivot coming through down here, but we won't talk about this in this video. Is about 6%, nice and tight. And then the third and final contraction where you get this mini VCP is about 6% as well. So it's not going to kind of perfectly the depth of the contractions half each time. It didn't work like that. It's just kind of general principle. You'd like to see depth of the contractions diminishing each time, so decreasing, structural high lows, volume drying up as well. And it's also good to see, you see this here, really high volume coming through with positive price action as well. Then the stock starts basing out there afterwards. Something to be training your eye for as well is maybe this is a little bit woo-woo, maybe not, but you see in here, see how you're starting to get when you kind of transition. If we were to split this base into kind of like thirds like this, right? So we've got our first third, our second third, and our third third. What you ideally want to see is you transition through, you could do it in halves, you could do it in thirds, you can do it in quarters, whatever works for you. But visually you're trying to spot the high lows forming, but also the volatility of the price action calming down as well in conjunction with the volume drying up. So you can use candlesticks, you can use bars. I like candlesticks. I think there's more information. It's just how my eyes work as well. But you see how if you compare the volatility of just the candlesticks in the first third relative to the second third, do you see how it looks different? Price is moving to the downside when these kind of pullbacks come in this first decline quite aggressively. You have a couple of widespread candlesticks to the downside. Do you see that? Especially if it's happening on volume. What does that tell you? It tells you that there's supply coming to the market. But as you start transitioning across, see how we're just not seeing those kind of obvious bearish candlesticks coming through. Sure, there's a couple of little ones in this third one, but not really. And the price action is just really tight. Again, 10 EMA, 21 EMA, see the importance of that there as well for when you start getting those trigger bars. So this here is probably top 3 of my favorite VCPs from the Trade Like a Stock Market was a book. And then it gets out really well. Another kind of little subtlety here is if the stock has a 52-week high on the breakout bar, that is a very, very, very good sign. Indeed, it means you're probably trading one of the strongest stocks in the market. So looking for those 52-week highs on the breakout bar is a good little nuance, a little subtlety. Let's go to, this is American Superconductor. So we're back in 2003, 2004 here. So bigger base forming here, positive reaction to the earnings. The stock is a leader before actually going into the base. See these 52-week highs coming through here? That is really good to see. Then you get the first contraction here, bounces. There's a low pivot similar to like you saw on Cyrus Logic. There's a low pivot coming in here. What do you notice about the bar beforehand? See how you get this really tight trigger bar? So trigger bar, it's an inside bar, really tight bar, probably the tightest bar thus far within the base. In the context of building a pivot, that's a high low. Volatility is contracting, volume dries up. That's really good to see. And then you also get over here, you get actually a mini VCP again. So fractal nature of the market, bit of a VCP. A little cup and handle as well. You could look at that as well, but bit of VCP action within the larger VCP, but price starts tightening, trigger bar coming through. Look how the volume dries up, RS line turning up. Really nice. So again, what are you looking for? You're looking for contractions. Most commonly, you're going to see between 3 and 4 contractions is going to be the most common, but you can also see these VCPs within VCPs when price really starts tightening up. So again, you could kind of split this in terms of the contractions that you're seeing like this. So I know it's not perfect thirds. The market does not work in kind of perfect linearity like that, but see, you get your first third, your second third, and then your third third. Quite commonly, you can see within that final third, you can see a VCP. You drop it down on, say, to 1 hour chart, you can quite commonly see a VCP within that as well. Let's go to Chipotle. So the point that I want to emphasize here is positive reaction to the earnings. So especially if it's a more kind of a liquid leader, it's a can slim type stock. For those of you who've read How to Make Money in Stocks by O'Neill, you'll know all about that. So see this here. You get really good volume coming through. It's about 3 times the 30-day average, and it's on the earnings reaction as well. So earnings would have come out after the close. Okay, after the close on Thursday, the 22nd of July, that's what that move means. After the close, bit of a surprise on the earnings, bit of a surprise on the revenue as well. But what's more important than that is the reaction. So what you see, the reaction to earnings is a gap up. The bar opens on the low, closes on the high. Now it's running into overhead resistance. What does overhead resistance mean? It means there are trap buyers within the base who are buying up here. They've sat through this decline. So when they start getting back to break even, what do you think they're going to try and do to remove the loss, remove the pain from their trading portfolio? They're going to be pressing sell orders come to the market, supply and demand scale balances. So that means you then, as you run back into this overhead supply, you then start getting the contraction. Now the contractions again should be building higher lows, depth of the decline, so on and so forth. So you can start to see that after the earnings, this is when price powers back up, a little bit of kind of a change of character. So again, if we split this one here, it makes more sense to do this in a half this time. So we have kind of the first half and the second half of the base, and it seems like earnings was the catalyst for kind of turning the tide of supply and demand here, because before that, in the first half of the base, is pretty choppy price action. I've got absolutely no interest in that. There's a lot of these what I call bearish synchronicity candlesticks. We're in the second half. See how the stock, I know it's visual. We're all looking at the same thing here, but we all interpreted it differently. There's a very good quote about that. It isn't what you're looking at. It is what you see. We all see things very differently. But for me, the second half of this base, the stock's now acting differently. We're building higher lows. We're tightening up. Look at the volume dries up consistently once we get the first couple of bars. If I just kind of like pull this forward here, see how from here onwards volume is consistently below the 30-day average, higher lows. Look at the RS line turning up. Now this is another subtlety as well. The stock has 52-week highs before the base, and it has 52-week highs whilst it's still in the base. So if you get 52-week highs coming through while the stock is still in the base and displaying constructive basing action such as a VCP, volatility contraction pattern, that there is usually a good sign. I cannot interpret that ever as a negative sign. If the stock's hitting 52-week highs and it's still in the base, that there is an incredible sign of strength. So just a couple of takeaways there. Think about the earnings reactions. You can see it here. You can see it here. Think about what happens thereafter the earnings. Think about the volatility of the base decreasing from left to right. Split it into thirds, into halves, into quarters. Whatever works best on the individual base as well. Volume drying up. 52-week highs in the base. Really good to see. I said I was going to give you a little bonus one. So here's a bonus one. I think it's on page 180, 182. You'll see a Walmart example. from 1982, but if you go back 4 years to 1978, there's a really nice VCP. I covered I think the 1982 Walmart in a recent VCP video, so I thought I'll chuck this one in and do a different one, because this here is a really nice low pivot. So we have our contractions. You actually have 4 contractions in this space. So first contraction minus 17%, bounces. Next contraction 15%. Okay, so it doesn't kind of half the volatility, but then it does thereafter. So it's not going to be perfect, guys. It's not going to be. It's going to go from 20% to 10% to 5% to 2.5%. It doesn't work like that. Again, it's understanding the principles of the VCP, what is going on from a supply and demand perspective, and applying a great deal of common sense, which is not very common. So first contraction, second contraction, 15%. Now price starts tightening up. Bounces, third contraction, 6%. Bounces, next contraction, 2%. That is extremely, extremely, extremely tight. Cannot stress that enough. The stock, again, is hitting 52-week highs in the base. RS line is turning up into the breakout. Now, it is more rare on a low and a mid pivot to see a 52-week high coming through on the actual breakout candlestick through the pivot. If it does, that there is a great sign of strength, but it's more rare to see that. It's more those higher base breakouts where you will see the 52-week high coming through if the stock is a leader and or very soon after. But a couple of points here you can read. You can read the kind of annotations in here, but you see how tight the price action starts getting here, and see how it's just then consolidating above the 10 EMA, the 21 EMA, the 50 SMA. You got the grey line being the 100 SMA in here as well. Look how the volume just dries up. So this is quintessential kind of perfect pivot behavior, if you like. Multiple tight candlesticks. I'm sure many of you have read the Davis book as well. So ideally getting that kind of little Davis box in the pivot, little mini VCP as well. But this type of action here, I like to think of it as a mini Davis box, mini VCP, just price going sideways, tightening up, volume drying up as well, just means it can look like a really nice tight low risk setup. So that is it, guys. I will wrap it up there. Thank you very much for watching the video. Hopefully you're enjoying these Minervini VCP ones, and I will see you in a future video.